Markets cannot handle this 60s style improvement. Active investors today have never personally experienced such an environment. This creates a serious risk of error. Too much good thing. It could be too much of a good thing if the United States has a problem right now. The economic recovery resulting from last year's takeover is advancing at a remarkable pace, and financial markets are cheerfully moving to price an ongoing recovery as a reality. As I talked last day, the first quarter was the worst period in 40 years for bonds. Meanwhile, the S&P 500 finished April 1 over 4,000 for the first time in history, after gaining just over 7% in 3 months. And the dollar got stronger, so the markets are clearly keeping pace with this fast-paced recovery. Here are the highlights. Last week brought reports that ongoing and initial unemployment insurance claims are falling again. They remain alarmingly high, indicated that the economic pain continues. However, the recovery speed is almost as outstanding as the speed of the accident before. Friday's unemployment data surprised the rise. Looking back to the 1970s, the pace and severity of last year's recession seems almost off the charts. But the same goes for recovery. At 6%, the traditionally measured unemployment rate is still very high, and policymakers undoubtedly want to lower it even further. However, this has been an economic cycle unlike any other. We can take consumer sentiment data that shows some degree of verification for the number of unemployed. So far, consumer confidence has barely improved and has lagged far behind other indicators. The consumer is much less confident than the average trader in the financial markets. Still, both most closely watched polls now show clear development from the bottom. Whether driven by the introduction of the vaccine or tangible improvement in business, this should increase the chances of consumers spending the big bucks they have later this year. Meanwhile, production has not been so sure for almost 40 years. The chart below shows ISM production data. Any number above 50 indicates expansion, while any number below indicates a recession dating back to 1950. Consensus estimates compiled by Bloomberg are also included in the period we have. This month's poll was truly fantastic. Procurement managers are very optimistic and more than economists and analysts expected. Looking back in history, numbers like this were common in 1950s and 1960s, when economic cycles tended to be shorter and more pronounced. It is almost as if the epidemic suddenly brought us back to the world that existed when the dollar remained tied to gold and stable demographic growth helped drive economic expansion. Such an environment is so different from anything that is personally experienced by those active in the markets today in their professional lives that there is a serious risk of error. We are no longer used to such sharp cycles. If you make any investment or legal decision, it is advised to consult an expert before making this decision.